Hello everyone, myself Dr. M. Monika, Assistant Professor in the Department of Business Administration CE, St. Joseph College, Cuddalore. Today we are going to see about the capital structure. What is meant by capital structure? Capital structures is the part of financial structures which represent long-term sources. The terms capital structures generally defined to include only long-term debt and total shareholders' investment. It is the mix of long-term sources of funds such as equity, shares, reserves and surpluses, debentures, long-term debt from outside sources and preference shares capital. Definitions of capital structures given by some financial experts. According to Heisenberg, capital structure of the company refers to the makeup of its capitalization and it includes all long-term capital resources was loans, reserves, shares and bonds. John J. Hampton. Capital structure is the combinations of debt and equity securities that comprise a firm's financing of its assets. According to I.M. Pandey, capital structure refers to a mix of long-term sources of funds such as debentures, long-term debt, preference shares capital and equity share capital including reserves and surplus. Next, capitalization, capital structures and financial structures. In terms capitalizations, capital structures and financial structures do not mean the same. Capitalization, it refers to the quantitative aspects of the financial planning of an enterprise. It refers to the total amount of capital raised for its long-term requirement by share debentures, borrowing, etc. Capital structure refers to the pattern and the proportion in which the composition of the capitalization is done. Financial structure describes the way in which short-term and long-term assets are included. It refers to financial resources and the composition of percentage of short-term and long-term sources of funds. The capital structure is the part of the financial structure. Next, importance of capital structure. Increase in value of a firm. A sound capital structures of the company helps to increase the market price of shares and securities, which in turn lead to increase in the value of the firms. Next, utilization of available funds. A good capital structures enables a business enterprises to utilize the available fund fully. A properly designed capital structure ensures the determination of the financial requirements of the firms and raise the funds in such proportion from various sources for the best possible utilization. Next, maximization of return. A sound capital structure enables management to increase the profit of a company in the forms of higher return to the equity shareholder. Example, increasing in earning per shares. Next, minimization of cost of capital. A sound capital structures of any business enterprises maximizes shareholders wealth through the maximizations of the overall cost of capital. Next, solvency and liquidity position. It never allows a business enterprises to go for too much rises of debt capital because at the time of poor earning the solvency is for compulsory payment of interest to the debt supplier. The flexibility. It provides a room for expansion or retention of the debt capital so that according to changing conditions, adjustment of capital can be made. Undisturbed controlling. A good capital structure does not allow the equity shareholders' control on business to be diluted. Minimization of financial risk. A debt component increasing in the capital structure of the company, the financial risk will also increase. Next one, factors influencing capital structures. It classified into two: internal factors and external factors. Internal factors: financial leverage, risk, growth and stability, retaining control, cost of capital, cash flow, flexibility, purpose of finance, asset structure. The external factors classified into size of the company, factors of industry, investors, cost of flotation, legal requirements, period of finance, lever of interest rate, lever of business activity, availability of funds, taxation policy, level of stock prices. The next, optimum capital structures definitions. It means capital structure has such a portion of debt and equity which will maximize the wealth of the firm. At this capital structures, the market price per shares is maximum and cost of capital is minimum. The definitions of optimum capital structures, according to E.F. Brigham, defines the optimum capital structure strikes that balance between risk and returns which maximize the price of the stock and simultaneously minimizes the firm's overall cost of capital. The features of an optimum capital structures: the simplicity, profitability, solvency, flexibility, conservatism, control, optimal debt equity mix, maximization of the value of the firms. The first one, simplicity. All businessmen are not educated. A complicated capital structure may not be understood by all. So all the rise that create confusions. A capital structure must be as simple as possible. Profitability. It is one, maximize the earning per equity shares and minimize the cost of financing. Next, solvency. The content of debt will be the reasonable proportion of the total capital employed in the business. The flexibility of the firms should be such that it can raise funds when required. Conversation. The debt content in the capital structure of the firm should be within the borrowing limits. It should be free from the risk of insolvency. And control. The capital structure should be designed in such a way that involve minimum risk of loss of control of the firms. The optimum debt equity mix. The capital structure of the company would point where the weighted average cost of capital in minimum. Next, optimum debt equity proportion establish the balance between own capital and debt capitals. The next, maximization of the value of the firms. It makes the value of the firm maximum, constrains the optimum debt equity mix in the difficult to ascertain its two sense. The concept appropriate capital structure is more realistic than the cost of optimum capital structures. Thank you everyone.